Should you invest in real estate or the S&P 500? To simplify things, we're going to look at the real estate markets in California, Texas, and Florida, which account for 27.4% of the total US. First, let's look at primary residences bought with cash. This is often done by wealthy people who don't want the hassle of getting a mortgage. In 1990, the median home price in California was $212,000. In Texas it was $62,000, and in Florida it was $76,000. Around that time, the S&P 500 was trading at $325 per share. Fast forward 33 years later, and the median home prices for each state has skyrocketed. California is now at $743,000, Texas at $257,000, and Florida at $392,000. As of this video, the S&P 500 is at $4,407 per share. So clearly, everything has gone up. Assuming you paid cash for your primary residence, the S&P 500 is clearly the best investment at 8.21% compared to real estate. Florida beats Texas, and Texas beats California in terms of where you should have bought your home in 1990. Next, let's look at primary residences bought using a mortgage. This is the most common type of real estate purchase. From 1990 until your mortgage ended in 2020, you would have paid a lot more in terms of total dollars compared to buying in cash. This is assuming you never refinance. During this period, you would have spent $687,000 for a home in California, $202,000 in Texas, and $247,000 in Florida. Today, you can see that your overall cost means your selling price isn't as great compared to buying in cash, although your initial down payment is far lower compared to a cash buyer. Fast forward 33 years, the S&P 500 is still the better investment for buyers getting a mortgage for their primary residence. In fact, this proves that the house you live in shouldn't be considered an investment. 0.23%, 0.72%, and 1.40% over 3 decades is a terrible return. Next time your mom tells you the house she has is an investment, show her these figures. Third, let's look at a rental property bought with cash. At this juncture, you can skip this section if you like, since it's mostly rich investors who occupy this thought process. As noted, in 1990, these were the median home prices for California, Texas, and Florida. Note here this part assumes your tenants have paid an amount equal to what your mortgage would have been. Fast forward to 2023 and the purple line is the total amount you would sell your property plus all the rental income you received during the last 33 years. You can see here that you'd have $1.39 million in California, $459,000 in Texas, and $639,000 in Florida, compared to the price you bought the house back in 1990. However, the S&P 500 still beats this method of real estate. California comes to 5.85% compounded annually, Texas at 6.2%, and Florida 6.64%. This also assumes the rental income you received was not reinvested in anything else, just to keep things simple. Fourth, let's look at a rental property bought using a mortgage. For many real estate investors, this is the primary method of buying a house. In 1990, this is the median down payment by state. California at $42,000, Texas at $12,000, and Florida at $15,000. Fast forward 33 years and this is the median home value by state, which we noted earlier in this video. But see how much less you're actually putting down. Assume the renter is paying your mortgage. Of course you'll probably raise the rent, but to keep things simple, let's say they aren't. You can see here that this method actually does better than the S&P 500. In California, you'd achieve a 9.05% compounded annual return. In Texas you'll receive 9.57%, and in Florida, you'll get a 10.32% return. To sum everything up, during this 33-year period, only a rental property bought with a mortgage would beat the S&P 500 over the long term. However, if you include the work that's needed to be put into real estate, perhaps it's easier to just put your money in the S&P 500. It all depends how much actual work you want to put in. Invest wisely, and as always, take care of your money.